Alright, hello everyone, welcome to the live stream. I think we should be live now, so thanks to those of you who joined so far and for being early birds. If you haven't seen me before, then that means you haven't watched my latest video interviewing Raj from Evolve ETFs. But welcome, and yes, I'm a real person and not just a AI voiceover. Just gonna wait a little bit for some more people to join, but it's just a kind reminder that everything we're going to go over today is for informational and educational purposes only and should not be considered as financial advice. These are just my own observations and how I personally look at the markets, so just get that disclaimer out of the way. How's everyone doing today? Let me adjust the settings a little bit. That way, if you're not subscribed, you can probably still comment. Nice. I don't think I've ever tried Wi-Fi on a flight before. Been a while since I traveled. Alright, so we're gonna go over a lot of things in this live stream, and it's gonna be a little bit free-flowing, so we'll just see how it goes. But the focus is going to be on the Canadian cover called ETF dashboards that are available on my Patreon. I don't know if I'll go over every single sector, but we'll see how many people stick around as we go through them. If there's any special requests or sector-specific ETFs you want to compare, just let me know when we go over to that segment, and you can also use the super chat, and I'll get to it as soon as possible. So just the final check before it gets started. Is the background music volume okay, or should I turn it down a bit? Can everyone hear me fine? Alright, I guess no. Alright, there we go. Gotta see some feedback from you guys in the chat so I know you can at least hear me. Alright, sounds good. So, in terms of the general market, let's just take a look at where we're at currently. So, looking at S&P 500 on the one-day chart, looks like we're just at 0%. So, on a Friday, it was basically flat. So, we didn't move at all. It was just like holidays and all that. So, usually the Santa Claus rally happens around this time. So, we'll see if we get that tomorrow going into the first week of New Year. So, these next 7 days are usually when we get that. We'll see if we get it this year. On the 5-day, the S&P 500 is up to 2%. The 1 month, about 1%, so pretty much flat. On the 6 month, we're at 11.68%. And then year to date, we're at 18.09%. It's pretty crazy considering we saw us at during the decline here into the Liberation Day tariffs, 18.9% down. And then April 8th to today, 39.08%. So kind of jealous actually of people who started investing right when the Liberation Day happened, because even in less than a year, they're already up 40% basically in their portfolios. So good timing for sure. Context wise, if we go back 1 year, 17.32%, and 5 years, 84.5%. Then we go max. See, this here is just like right here is the pandemic. That was a 23.79%, but on the chart here, if you just look at it zoomed out, yeah, you can see it obviously dip, but even the same thing with the Liberation Day tariffs here. But overall, we're much higher than we were back then. So, and it shows you just time in the market by the fear. We do the same thing with the NASDAQ, basically flat on the 1 day, almost 2% in the last 5 days, flat in the 1 month, 13% 6 months, year to date, 22.26%. 1 year, 20.98%, 5 years, almost 100%, and then max. So a few more wild swings in the NASDAQ for sure, but generally it's going up just because of the tech. In terms of, let's see, I can show it. Show up 1 sec. There we go. Okay, yeah, so this is a chart just updated last night. So currently 19.3% 2025, and this is as of the close on Friday. We're looking at basically a 20% increase in the S&P over the last 3 years. Not quite there right now in this year, but I think we'll probably get there in the next couple days. So 3 years of 20+% increases is pretty crazy. I don't think we ever had. We had what, 1, 2, 3, 4, 5 years. It's from 95 to 99. But other than that, I don't think we have anything that similar. So this kind of goes to show, even if we have a bad year like we saw in 2022, we'll recover. And then if I switch over to the NASDAQ, I had to double check this 2023 number, 53.8%, but that is accurate. So that's just because in 2022 tech just plummeted, and then if you got in at that time, you would have seen crazy amount of gains. But yeah, the NASDAQ definitely I think will be over 20% these past 3 years. Don't know if it'll continue, but if you go back into that 95 and 99 period, you see 42, 42, 20, 85, and 101% increases. So yeah, we'll see if it continues in the next year, 2026. So let's see, the next thing we can go into is for market context wise. Switch over to this main view, but I went over this in my previous video. Not many people watched it, but I think just context wise to give you an idea of where we can go in the market. I think this video is useful, and if you're interested in technical analysis, this is useful. But in this video I talk about the 3 main indicators. So the 60 SMA, and then the fair value gaps, and support and resistance. I'm not going to spend too much time on it just because it is pretty technical. I don't think a lot of people are that interested in it, but just in a general sense, for the 60-day SMA, there's this line here in the white. So if you're above the line, which is this green area, that means we're seeing more bullish sentiment. So the 60-day SMA is a lagging indicator because it's based on the previous 60-day time period and prices. So it's going to be a bit of a laggard, but it is helpful and it's popular one that a lot of people use. And then if we drop below this line, which we were dropping when I made this video, it means bearish sentiment is coming into the market. But again, it's a lagging indicator, so it could dip below it and still mean that we're still in a bullish scenario. So that's the 60-day SMA, and the second one is fair value gaps. I think this is one that's worthwhile to know, just because I think this tells more clearly and more clearly how the market is going to move and where it could potentially move to. Because it's based on the options and orders and resting orders and liquidity in the market. So that's fair value gaps. So there's the first candle, second candle, 3 candle pattern, and the fair value gaps in the middle from the second candle. So what this means is that there's an imbalance in the price, so the market went up too quickly, and then that would mean there are orders sitting in this area called the fair value gap that didn't get executed. So oftentimes the price will come back down and visit this area before it goes back higher, or go lower, but the notion is that it will eventually come back into this area at some point in time, just to fill in the liquidity and the orders. It's not guaranteed all the time, but it's just an idea to give you where a market can move. And third indicator is pretty simple, it's just support and resistance. So these are just areas that price has visited a couple times and acted as either support or resistance. So you can see here, kind of hit it 3 times and then acted as resistance, but eventually it broke through, and then once it became support, you see it hits it a couple times, and then the most recent time in this video was another support area. So in this video I kind of showcased how at this point in time it hit a support area, and also we're seeing some bearish sentiment come in, but we don't know whether or not it's either going to go back up to hit this fair value gap and hit the orders here, or go down and fill in these orders here. So I use this to tell me where the market could go. There's no saying when it will get there, but at some point it will get here. So if we flip over to what actually happened after this day, we can see the same thing here. So this was what I showed in the YouTube video. So this last update, we hit a support level, and also hit a support level, and we weren't sure if it was going to go down or go up, but we saw that eventually it did go back up. So let me see if we can draw an arrow. So we went from here to up here in this red square, and this red square is a resistance level. So you can see here, mark that same red square here, a rectangle, and then once it hit it, we know that it's a resistance area. So the price eventually went back down to retest from that resistance and then eventually broke it, and then we ended up testing another resistance level, so a previous high here, and then it sold off and rejected, and then had to fill in these fair value gaps that are created here. So you can kind of see that, okay, it's gonna go visit certain areas based on the liquidity in the market. So it filled in all those orders, and then eventually once it filled in that green support rectangle, it went back up. So this is just the index, it's nothing fancy. So right now we're currently right here. So we have these support rectangles, so this means the price of the index could eventually fill back in these gaps here. Right now we're at an all-time high. There's also the simple moving average here, which acts as a support level. So if I were to use this in terms of context of like investing, I would say if you're looking for better pricing, I might wait for the market to drop back into these support levels just like it did here before you put in orders for the market. But if you're just a DCA, you could DCA at the top here, and then when you see it hit these support areas, you could maybe double down. So this is not it's not to tell you to trade, but it's just a way to kind of look at the market and maybe get a little bit of an edge in terms of when you put in your money into the market. It's not for everyone. I think for me, I like to look at the markets and keep track of what is going on. So it's just another fun way for me to look at the market and get an idea. Let me know if you have any questions so far, but I'm gonna move on from this if there are no questions. So the next thing we could talk about is Bitcoin. Everyone's favorite. Let's see where we're at. So Bitcoin, it's kind of flat on the day. 1 week down 1%. 1 month negative 4%. Year to date negative 6.24%. 1 year 7%. It's kind of trading in a range. I think there's a support level here, so I think we've seen the bottom. We're just gonna have to wait. On the 26th, there was actually news for like the options expiry. So on the 26th, there was the largest expiration of Bitcoin options in history, apparently, and all those orders are now lifted. So we could potentially see some more volatility step back into the market for Bitcoin, and the new year we could maybe see it go back to all-time highs. Optimistic, doesn't look that way right now, but we'll just have to see. In terms of seasonality, you see this blue line is 2025, so we are negative on the year. In past years we've seen it sort of rally, but this is not the year we see a rally. This is the year we kind of see it dip down. So volatility wise, it is Bitcoin, so you should invest only what you're able to handle and stomach. So next thing we'll get into is the covered call ETF directory. So on the Patreon, when you sign up as a member, this is what you're gonna get. You'll see we have the 21 individual dashboards, and then there's also a community spreadsheet. So inside the community spreadsheets are just a collection of all the spreadsheets that I've built in the past and have available for all the members. I'm working on one currently on the market rotation and also a fear and greed index. So those of you who are subscribed can expect to see that sometime soon, next month maybe. But yeah, let's just go into the directory. So here I basically put together every single cover call ETF that's available on the Canadian market. So BMO, Brompton, CI Financial, CIBC, Evolve, Global X, Hamilton, Harvest, JP Morgan, Mulvihill, 9 Point, Purpose, and Royal Bank. So what are we at right now? So in total right now we have 275 cover call ETFs in Canada. I think I'm actually missing one. I think in JP Morgan from Purpose Investments, but so 276. But yeah, I built this to give you an idea of what the landscape looks like. We can also filter by column. So if you filter by inception, you can see the earliest one I have here is CIC from Evolve or CI Financial, and that was August 18th, 2010. And then if I scroll down, when we get to 2025, yeah, 2025. First ones we had were from Harvest on January 16th. So if I highlight all of these, change this count. So yeah, 88 new ETFs, cover call ETFs launched in Canada this year. 89 if you include the JP Morgan. Yeah, it's been a busy year with cover call ETFs. If I filter by frequency or distribution, doesn't really tell me much, but yield is more appropriate. So the highest yielding cover call ETF right now is from Harvest, and that's the CRCY circle. The yield of 56.78%. So it's actually beating MSTE, which is second place now since they dropped the distribution to 20 cents. And third place we have CNYE, Coinbase, 46.61%. And then fourth place we have Coinbase again, which is from Purpose this time, 42.78%. We're talking about basket of stocks. We actually have Bitcoin up here. BCCL is up here, 34.88%. Okay. Yeah, in terms of like baskets, Biggie is number one, so 31.24%. The next sort of basket type probably be HBTE here, so 29.5%. And then after that, probably HHIS, so HHIS is 25.45%. Yeah, those are your kind of rankings in terms of big baskets. So Biggie, HBT, and the HHIS right now. This one's a for fun kind of column, so $1,000 invested. So $1,000 invested into Circle right now, you would get $567.82 per year. MSTE, put in $1,000, you get $509.55. So yeah. In terms of this column here, so these are linking to the individual dashboards that I built that we're gonna go over. Some of these are ends. Ends means I haven't built them yet. but most of them, I wouldn't, probably just a lot under half of them probably have dashboards. So yeah, I think this is useful. So I update these, and these are all live. So they update their individual prices every 20 minutes automatically, and then I think once a day it updates the distributions. So yeah, this is all live and current data. If you go back, I also have a underlying stock and YieldMax and Harvest ETF dashboard. So this is comparing the underlying stock, so Tesla, TSLY, and then TSLY, so TSLY from YieldMax and TSLY from Harvest. And you can kind of see certain days and for certain reasons, some may outperform or underperform the other. But in general, I don't think I would recommend YieldMax. I think a lot of people have started to realize that YieldMax is not ideal for growing your total returns. If you're interested in just income and income itself, maybe, but I've had the TSLY for a year and a half. I got rid of it probably last year, but it's not something I would recommend personally. I think you're better off sticking with some of the steady ones or just going with the Harvest ones on the Canadian side. And also a passive income calculator. So I've updated this to handle semi-monthly distributions. Probably seen it in a previous video, but yeah, I've also added some new functions to it. So yeah, it takes semi-monthly distributions now and gives you a calculation based on your initial investment, monthly contribution, projection in years, and then price growth and dividend growth. And then tells you distributions at the end of the amount of years you put in. So semi-monthly you'll get this much, annually get this much, and then total distributions collected. And then this chart will tell you when you're going to break even. And also updated on the table here highlights how long until you'll break even as well. But yeah, that's just some examples of what I have on the spreadsheets. Any questions so far? Welcome to 15 of you. So I guess at this point we can probably go over some dashboards. I'll set a goal if anyone wants to request specific ETFs or dashboards that you want me to compare right away. But yeah, set a goal there. But yeah, so these are the 21 currently available dashboards. Which one do you want me to go over? If there's no specific one people want to see right now, maybe I'll just start from the top. All right, no requests. So maybe we'll start with the S&P 500. Or should I start with HHIS? 9 Point. I actually don't have anything with them right now, but I mean, the management fee is low, 0% currently, 25% leverage, up to 50%. I think they're a good option. Depends on which ones you get. So this is the 9 Point high shares Canadian one. Just keep in mind that you should always look at the underlying holdings. So for this one specifically, you're gonna have a lot of exposure into Barrick Gold, a lot of exposure into uranium, and a lot of exposure in Shopify and Canadian natural resources. So typically over 10% is going to be quite a large portion of the portfolio, and allocation wise it's going to move the ETF much more. So if you believe that these will go up, then yeah, it's a good investment. Just also keep in mind that the reason why they have some of these a bit higher maybe is also for the distribution. Shopify might have more liquidity and more options premiums. But yeah, take a look at the underlying stocks. Generally, I've been burned before with telecommunications, so I've tried to avoid any ETFs that have Bell or TELUS in them. I've held Bell and TELUS for a year, maybe 2 years. I had to eventually sell at a loss, so I don't want to get back to telecommunications. Yeah, this one's ECHI. Yeah, I don't follow them too closely, but it's a good option. I mean, the management fee is 0% until February. And they have good names. I mean, gold, obviously, if you haven't noticed, gold's all-time highs, keeps going up. Silver's all-time highs. So precious metals might be a good play for 2026. I don't know. But yeah, just because of the overall landscape of things right now in the world. Uranium is a good play. EVs need uranium and other things. So and Shopify is a really good one. I think they're close to all-time highs too. I was looking at Shopify when it was $35, but now it's like almost $200, so should have jumped in, but shoulda, coulda, woulda. European banks and US banks. Okay. I'll look into the US banks dashboard in a bit. Answering some of the questions. Covered call ETFs, high expense ratio. Yeah, so I mean, expense ratios, you're gonna see high expense ratios on them. I don't know. I think HYLD, I think is one that a lot of people like to poke at. So here it says management fees 0%. So it says clearly that it's subject to the fees of the underlying portfolios, which are all of these ones, which is their own individual yield maximizer ETFs. So what you usually have to do with these is go into the documents and then go into their ETF fact sheet. And then maybe it's not the ETF fact sheets. A prospectus. Yeah, it's this one right here. So it's the ETF facts, not the fact sheet itself. But if you scroll down, there's usually a section here on expense ratios. So it will tell you clearly that the management expense ratio is 2.37%. So it's not zero. So this is 2.37% is all the underlying ETFs that it holds. And then there's also a trading expense ratio, so 0.07%. And then in total, it's going to be these two added together, which will come to 2.44%. So in terms of performance, this is including all the leverage fees and everything included to operate the fund. And what you see in terms of performance are net of these expense ratios, so you don't have to pay any additional fees on top of what you get in terms of the distributions. So generally, most people probably see it as just a moot point. They don't really factor into the overall performance just because it's already taken out of the distributions, it's already taken out of the performance before anything gets to you. So yes, some of them have, or most of them probably would have higher expense ratios because of the ones we're looking at are leveraged. But if the underlying performance is better than a passive index fund, then paying these higher expense ratios, I would say is worth it. So you just have to look at the total return performance and if it matches your expectations. Alright, so let's just go into HHIS first. So HHIS, alright. I just updated this recently, so everything here has all the newer ETFs that just came out. Zoom in a little bit so it's easier for you to see. Okay. So this chart here is going to be the total return comparisons, and this is year to date, so from the very start of the year. I've also included VFV and VSP just so you can see how it compares to the indexes. So VFV is unhedged and then VSP is hedged. And then we all should know all the holdings in HHIS are unhedged. So you want to compare, if you want to compare fairly, is to VFV. One thing to also keep in mind is that for all these charts and all these comparisons in general, actually, is that you need to look at these from the comparisons here are going to be very specific in terms of the scenario. So this is a year-to-date comparison. So this is saying if you put in all your investments at the start of the year, these values are going to be what you will get in terms of performance. But we all know that this isn't the case. No one's going to lump sum one time at the start of the year and then never touch it again. So these values are very specific in terms of based on a single lump sum investment at the start of the year, and you don't ever touch it or reinvest, then this is what you will get in terms of total return. Okay, so some of these are going to outperform or underperform depending on your own personal scenario, but these charts and everything on here are just going to be based on a single lump sum investment. So just to get that clearly out of the way. And also here, you should know that a lot of these came out at different times throughout the year. So some of these are not exactly 1 year. So these are going to be from when they first came out. So some of these ones at the end here came out much later in the year. So like the second half of the year. So these performances are just since their inception and not from the beginning of the year because they weren't available. So in general though, VSP, so this is beginning on January 1st, but HHIS came out on January 16th, and it's currently beating the S&P 500 indexes, 23.26%. Best performer so far year to date is obviously Palantir for PLTE, 162.7%. That's crazy. Yeah, not much to say about Palantir. I missed the boat on Palantir for sure, but those of you who got in for Palantir, good job. And yeah, it's kind of scary to jump into that one right now, but if you believe in it long term, yeah, keep holding it. Some other really good performers: Google 75%, AMD 90%, EVGY, so that's Broadcom 80%. Worst performers, you can see MSTE, obviously, so negative 36.28%. And funny enough, there's one worse than it, which is Circle, which we all saw earlier in the cover call directory, that it was the highest yielding ETF right now. And this is probably why, because it's dropped 42.67% since its inception. So, yeah, it's risky. I think the way they're approaching is that they're kind of slowly adding to these last 4 positions, and I think it's a good thing because these are so volatile that you wouldn't want it to tank the performance of HHIS in some of these investments. So, yeah. Performance wise, let's go into here. So this is the next tab over, and currently I have it October 1. So October 1 is when these last 4 just came out. So so far for these 4 anyways, you'll see the total returns. So you look at it from a column standpoint. So the underlying stock for Circle went down 37.01%, and then the Harvest one went down 42.67%. So Circle, or CRCY, has underperformed the underlying stock. The reason for this is probably because of the leverage component. So that's probably why it's underperformed. In terms of Reddit, up 11.44% since its inception, and then the RGDY ETF is up 9.18%. Reason for this underperformance probably might be because parts of it were capped. So we know Reddit, or at least these last 4 are very volatile, so not surprised it's underperformed, but about like 2% underperformance. Robinhood, negative 15.1%. And then HODY, negative 15.86%. So these 2 are fairly close in line with each other so far. SoFi, 5.09%, and then SOFY up 5.81%. So the Harvest one is actually outperforming. So I think a lot of people will want to see how these have performed since April. So this is April 8th, after the Liberation Day tariffs. Just gonna wait for it to update. But we saw a huge crash and then a big recovery, a V-shaped recovery afterwards. So just to give a comparison, let me just maybe zoom in again closer so you can see. So Microsoft. Yeah, Ricky, this is these are all spreadsheets that I've made myself and update. So all of these will be accessible if you sign up as a Patreon member. Yeah. So Microsoft, since April 8th, right here, so this is the day after the Liberation Day tariffs and recovery, you'll see Microsoft 38.28%, and then MSHE is 35.01%. So the Harvest one underperformance about 3% roughly. Amazon 36.25% since Liberation Day, and AMHE has actually outperformed it. So AMHE is 38.77%. So even though we saw a big drop on April 8th, Amazon, since that recovery, is actually beating, or AMHE is actually beating the underlying stock in terms of total return performance. Eli Lilly healthcare, start of the year took quite a big hit, so it's recovered a lot. Healthcare is actually the best performing sector in the last couple months, 3 months I think. So Eli Lilly 49.02%, LLHE 40.1%. So Eli Lilly underperformance of about 9%. Nvidia since Liberation Day 97.88%. NVHE 94.39%. That's actually pretty good considering how volatile Nvidia could be. Harvest and VHE actually kept up within 3%. I think within 3% it's pretty acceptable. MSTR since Liberation Day, negative 33.26%. MSTE, negative 17%. So it's outperforming. Probably because of the covered calls. But yeah, I don't know. Maybe I have to double check this, but looks like MSTE is outperforming the underlying. This looks correct though, I think in terms of dividends. Yeah. Coinbase, 56.4%. And then the underlying, or the CNYE, 50.18%. So underperformance about 6%. Probably expected just because Coinbase is very volatile. Tesla since Liberation Day, 114.18%. And then TSLY is actually outperforming it by about 5%. So if you caught Tesla at the very bottom on April 8th, you've outperformed the underlying by about 5%, and you're up 119%. So pretty crazy, man, Tesla. I have Tesla, so I'm happy that it's up this much. Palantir 144% on the underlying, and then PLTE is actually beating it since Liberation Day, so beating it by about 10%. Again, could be the covered call writing, and also keep in mind the leverage component as well. So the leverage can help it outperform and underperform depending on the direction. In terms of Meta, 30.25% since Liberation Day, and then METE 28.72%. So it's within a 2% range. Google 115.3% since Liberation Day, and then the Harvest version 115.69%. So they're pretty neck and neck. Google's not the most volatile stock, so you won't get capped as much, and shows here that it's kept up pretty closely to each other. Yeah, I would say it's not gonna be the highest yielding one in terms of GOGY, but in terms of total return performance, it's kept really close to the underlying stock. AMD 174.89%. So this is probably based on all the deals and AI. And I think there was a couple days where they announced the deal and then they just shot up like 20% or something. So that might have explained why AMDY has underperformed by about, what, 14-15%? But yeah, more volatile, potentially more capped upside. But you're still getting 159%, so. Broadcom, AVGO, 126%, and then 95% for ABGY. Same thing, I think there were some announcements for Broadcom where it jumped up a lot. I think it's come down a little bit, but still, it's a bigger underperformance when you look at it. And then Costco hasn't done well this year, to be honest. So since Liberation Day, it's negative 3.47%. And then Harvest version, negative 8.14%. So again, this underperformance is probably because of the leverage. Netflix, up 8.54% since Liberation Day. And then the underlying, or the Harvest version, 8%. Pretty close. Netflix has gone down lately, but total return wise is pretty close. Again, it's not going to be the highest yielding one. So after going through all of these, you can kind of tell like some of these ones that are closer in terms of total return performance are going to be the lower yielding ones. And then the higher yielding ones are going to have more potential to be capped on the upside. Just because of that volatility. So in terms of Harvest HHIS itself, total return since Liberation Day, 68.88%. If you want to compare it to the NASDAQ, I know a lot of people who hate on HHIS are going to say you shouldn't be comparing it to the NASDAQ. Thing is, there is another ETF or index that's comparable directly to HHIS. So this is the next best option. And yeah, if you're comparing it to the NASDAQ since Liberation Day is up 44.12%. So HHIS has been outperforming it by quite a bit since Liberation Day. In terms of AUM, what else do we have here? AUM wise, looks like MicroStrategy MSTE has the highest AUM under all the HHIS ETFs, 302 million. And then the next highest is Tesla, 263. I think this is probably because everyone saw Tesla jumping up in the last month or two, so everyone piling in. The Nvidia one used to actually be number 1 or number 2, so it's now 3rd place when we look at all of them. And then Eli Lilly, 191 million in terms of AUM. And again, this one probably saw a surge just because of how healthcare has done lately. So HHIS AUM over 1.2 billion. Crazy. And this is less than 1 year. So yeah, it's definitely the fastest growing one in terms of Canadians. And it's only growing faster. I think it just keeps going up and up every month. Yeah, we saw the comparison in terms of the distribution, up 4% and then up 3.85%. So you saw my video, I predicted 27 cents and we're at 27 cents right now. So any questions on HHIS? I also have here on the mains page a 52-week high and low chart. So this is just to tell you how, maybe not now, but like when might be a good time to jump in. But also keep in mind there is sort of a drift in NAV, just because all these are distribution payers every month. There's a drift. I wouldn't call it NAV erosion, but I would say it's a drift in NAV every time it pays out. So the average price is going to go down just because the distributions get paid out every month. So it's not entirely accurate. And also some of these are not out for 1 year yet. But how you would read this is that this gray area is the gap between the current price and the 52-week high. And then this dark gray is the range from the current price to the 52-week low. So the larger the dark gray bar, the better, just because it means it's further away from the 52-week low. But if you're looking for a discount, then you want it to be as close as possible to the 52-week low. So MSTE, for instance, you can see the 52-week high is around here, and right now it's sold off. It's not quite at the 52-week low yet, but it's pretty low, pretty down there right now, so you could say MST is at a discount. Whereas if you look at Palantir, for instance, it's quite up here and pretty close to its 52-week high, so maybe it's expensive and maybe you want to wait for it to drop back down in order to place your orders. So this is just looking at 52-week high and low chart and price. Again, it's not entirely reflective of premium and discount and doesn't look at the fundamentals. So when you're investing in single stock ETFs, you always want to keep in mind the fundamentals as well when you look at these, and not just look at the price. Just because it's 52-week low, MSTE for example, it doesn't mean that it's cheap. You have to look at MSTR, which is the underlying stock, and the fundamentals and how that is doing in order to determine if it's cheap. You can't just look at a cover call ETF and say, oh, it's, say you bought in the past, it's $12 and it's back at $12. It doesn't mean it's cheap. Because it's paid out distributions over time, that average actually goes down lower and lower over time. So just because it was cheap when it was $12 doesn't mean it's still cheap at $12 6 months later. In actuality, it's probably closer to maybe $11 or $10 is where it would start maybe being cheap. So I'd probably make a video on that just to explain it better, but hard to explain just like this right now. Yeah. Let's just go into the S&P 500 one next, just because this one probably interests quite a few people as well. So this is the S&P 500 one. Let me zoom in. All right, so S&P 500. So how I look at this is these two black bars are going to be the indexes, and these two black bars on every chart or every dashboard. As you saw previously, there was also these two. So this is just a way to compare these ETFs to the index. But of course, we're comparing the index, so these two, there's going to be some overlap. But the VFE is unhedged and VSP is hedged. So I have these two specifically here also, just to tell us the difference in currency hedging. So make it easier for people visually to see. You can see there's a difference of about 4% between these two right now. So this difference here is the currency hedging aspect. And that's because the Canadian dollar has outperformed or performed better than the USD this year, is why there is this gap between these two. So VSP and VSP are the S&P 500, and the only difference between them is the currency hedging. So I put these next here so we can see the difference and see what the effect of currency hedging has on the performance of these ETFs. So in terms of this chart, I think you can kind of see pretty clearly HYLD is the best performing S&P 500 cover call ETF on this chart. Again, HYLD, it's not exactly the S&P 500. It's broadly similar to the S&P 500, which is also why it's able to outperform. So in terms of HYLD, what it holds is all the yield maximizer ETFs. So I need to update this. They don't hold the T-bill and bond ones anymore, but the reason why I think it's outperformed is because all these yield maximizer ETFs, their underlying holdings are all single stocks. So single stocks, I think in one of the interviews Adriano did with Hamilton ETFs, they did this because the individual stocks have higher options premiums than the index does. So that's why they're able to potentially add to this outperformance. So that's why when you look at it in comparison to all of these other ones, like USCC, and USCL, for instance, it's outperformed it by a large margin, and also why it's able to outperform all of these ones. So it's because of the single stock selection. They pick good stocks, and when you're picking individual stocks, you are kind of, your risk is the individual stock selection, but you also have a better chance at outperforming if you choose the right stocks. So there are a few components to HYLD that has led it to outperform the indexes by this much. As a sneak peek, just for you guys in the stream, I actually sold out of USCL. I'll have a video on it probably sometime January, but I've actually sold out of USCL just because of this outperformance by HYLD, and I redistributed most of it into HYLD just because of that. The only reason HYLD I was kind of hesitant is, and also just to try and even out my exposure to S&P 500 between USCL and HYLD, is because of the currency hedging aspect. So HYLD is hedged back to the Canadian dollar, but if it's able to outperform by this much while being hedged to the Canadian dollar, I think it's a worthwhile one to consider. So yeah, I'm out of USCL for now. So if we were to take a look at, in terms of comparing USCL and HYLD, so you can see that currency hedging alone, there's a difference of about 4%. So if we take 22 minus 4, it'll be 18%. So 4% out of this 22 is because of the currency hedging. If we take out the currency hedging, it'd be more of a 18%, and then 18% compared to 9% is still double. So this outperformance is quite a lot. Something for you to consider. So in this chart here, you can see I've divided into growth, covered calls, and leverage covered calls. And right now it's conveniently April 8th. So this is since Liberation Day performance. So since Liberation Day, you'll see VSP is up 38.04%, XSP 37.95%, ZUE 37.87%, HSH 38.64%, ESPX 35.31%, and HYLD is almost 50%. So since Liberation Day, HYLD has outperformed all of the other similar S&P 500 Canadian dollar hedged ETFs. In terms of unhedged, VFV 34, XUS 34, so all these are going to be pretty similar. They're just the S&P 500 but from different providers. Leverage growth, I'm actually interested in this one, USSL, and also the QQQL version of it. So this is leverage growth. There's no distributions with this, but compared to just the index itself, so if you just compare Global X to Global X, this is Global X's S&P 500 ETF, 34% since Liberation Day. And then the leverage growth, so if you add 25% to it, it's done 43.82%. So no distributions, but 25% leverage gives you quite a bit amount of performance on just the index growth portion. And USSL has actually outperformed USCL, which is not really a surprise, I would say, I guess, just because there are no distributions or no covered calls on USSL, so there's no capping. But in terms of Liberation Day and unhedged, USSL looks to be the top performing S&P 500 ETF. If you want to compare between the two, so Canadian dollar hedged and unhedged, HYLD is 49.65% actually outperforms every single one of these unhedged ETFs this year, or at least since Liberation Day, sorry. So as you can see, you can kind of quickly compare and contrast and see sort of what the differences are between these ETFs very quickly with this dashboard, and identify specific reasons why certain ones are outperforming and which ones are underperforming. Any questions or comments for this S&P 500 dashboard? In terms of the 52-week high and low chart, nothing to report. I think all of these are basically at all-time highs, just like the index is. So, yeah. If there's no questions, maybe I'll go into maybe a sector-specific one. Canadian banks. I think that's a fun one to go through. A lot of options. So again, if I go through it, sort of how I went through it previously. So first thing I would look at, HYLD and HHIS I would not say are comparable just because they hold very different things. HYLD holds a lot of sector-specific ETFs that is trying to mimic the S&P 500 allocations, and then HHIS is a holding of 19 tech and other kind of stocks. So I wouldn't say it's comparable. I would say you can complement each other if you want to hold both of them. USCL AUM. Yeah, the Global X ETFs in terms of the USCL and QQCL, they haven't really moved all that much in the last couple of months or even this year. In the certain times decline a little bit. But let me see. But I would say that the decline in the AUM is not going to be a huge deal. I would say if it drops below 100 million and keeps going down is when you want to start maybe thinking about picking another one, but it's an ETF, it's just a wrapper. It's not going to go anywhere unless they decide to close it. So I would have no issues holding USCL. It's still above 100 something million, 200 million, I think. Yeah, I think it's just a lot of people are attracted to the yield, and the yield on those index ones are not as high as something like HHIS or Biggie. So that probably hasn't attracted as much in terms of dollars from the DIY investor crowd. Yeah, USCL is reliable. So yeah, Canadian banks. This one will be fun because there's so many of them. So the first thing I would look at here, same thing like before and with all the other spreadsheets I have, is the index. So you have VFV and VSP here as the benchmark. So you can see all of these bars are above the indexes. So this means the sector as a whole has outperformed the index this year. And yeah, the Canadian banks have done really, really well this year. And you can tell by the performance of basically all of these ETFs outperforming the index. It's been very well. In terms of comparing, sometimes I forget which one's which, so I go to here and I would double check in terms of like which one's growth, which one's leverage growth, and cover calls. So there's a lot of different strategies in this chart, so you can't directly compare every single one of these. And I also noted down here as well, you can't compare some of these. So CEW, BNC, and Bank, they also include exposure to some of the other Canadian financial or life insurance companies. So these three specifically don't hold only the big six banks, whereas all of these ones hold the big six banks, but they have different strategies among them. So if we were to talk about the covered call portions, what is it? Covered call ETF. So starting from ZWB. So ZWB onwards, these are all covered call ETFs. And then left of ZWB are all the growth ETFs. So you can kind of see covered call ETFs are underperforming the growth counterparts. But again, some of these are holding different things. So it's a little more complicated to compare. But in terms of like the covered call ETF side of things, CB and K is actually the #1 performer out of all the covered call ETFs. CB and K, if you don't know, is actually the Mulva Hill Canadian Bank Enhanced Yield ETF. So this one is a monthly distribution with a 5.86% yield. And it provides you exposure to the big six Canadian banks with 25% leverage. And then it has options writing. So a portfolio coverage, I couldn't figure out what it is, but I think Adriano did a video on it recently saying how they only rate cover calls on the leverage portion of the portfolio. So maybe that's what the strategy is. But yeah, it just holds the big six banks, and it's the #1 performing one out of all the covered call ETFs this year. Second place, we have Bank. So Bank is one that I think I just did an interview with Raj, obviously, and he said this year they started off with 350 or something million in AUM, and now it's over 800-900 million AUM. So it's a fast growing one this year, and the performance here shows that it's done really well. For Bank, the most comparable one I would say is CEW. So CEW is also have here. So CEW holds big 6 banks, but also holds some financial companies and life co companies. So the difference between CEW and bank would be IA Financial, because bank holds the same number of stocks here. The only difference is IA Financial. And instead of IA Financial, I think they hold Power Corp instead. So it's a difference of one holding between bank and CEW. And CEW is not a covered call ETF. So CEW is a growth ETF, so no covered calls on it. And in terms of performance, bank is outperforming it by about 2% so far year to date. Thing is, CEW doesn't have leverage, so the leverage component probably helped it outperform CEW this year. But CEW and bank are probably the most comparable out of all of these ones here on this chart. BK, I don't know if I have, what was BK? BK ETF. Oh, it's a split share one. Yeah, I don't have split share ones on this, but yeah, it looks like it just holds the big 6 banks. 60, I don't have 60 on here. I haven't updated this one with 60, but yeah, it's still too new. I think it just came out a couple weeks ago. So if you haven't watched the interview yet, I would say go watch the interview, because it gives you a good distinction between the two of them, between bank and 60. So I would say if you want to focus on yield, then 60 would probably be your option. But if you're focused on total returns, I think bank will do better in the long run, just because you're not writing as much on the portfolio, so you're able to capture more of the upside. And it kind of shows here, right? If you're comparing it to just maybe ZEB or something, it's only underperforming by about 5%. So personally, I have bank. I don't have 60. I've held bank for about 2 years now, and I think I'm probably going to keep bank for now. I might add 60 maybe in a different account, but right now I'm just holding bank as my Canadian bank exposure. In terms of how HCal and BNKL has outperformed here, just to give you like context as to why these two have outperformed everyone by a larger margin. So HCal here is holding HEB, but it has 25% leverage on top of it. So this is not a cover call ETF. It's just HEB, which is the big 6 banks, equal weight, and then adding a 25% leverage on top of it. So you can see how adding 25% leverage can help it outperform by a larger margin. So HEB was what it holds. So if I zoom in again, so HEB is the unleveraged version, and then HCal is the leveraged version, 25%. So the difference between HEB and HCal was it 9%, almost 10%. So just adding 25% leverage can now have a almost 10% outperformance, or over 10% outperformance. So yeah, that's why HCal has performed the way it has. If I look at BNKL next, so BNKL BNKL also is another 25% leverage. And then it holds HBNK. So yeah, it's the same strategy as HCAL, where it holds the big 6 banks equal weighted and adds 25% leverage. Yeah, nothing overly complex about it, but that's why HCAL and BNKL have outperformed this year and are the number 1 and 2 for Canadian bank exposure. If I'm holding HDIV and HYLD, do I see a benefit of adding S-Day or C-Day? I would say if you want overlap and more stability within your portfolio, adding S-Day and C-Day would help, just because they hold blue chip dividend companies, and blue chip dividend companies are generally more stable. They're not going to be the fastest growing ones, but if you want that additional stability, yeah, I think you could have that overlap. For myself, I think technology in the next couple of years is going to keep going up. So I would say S-Day and C-Day don't exactly fit with where I think the next couple of years are going to go, but depending on your own circumstances and you want a more stable portfolio, I think adding S-Day and C-Day on top of HDIV and HYLD could be an option. I think those DayMax ETFs, I think, still are some of my favorite ones this year. Just because the innovation around it and how they're only using the leverage portion for the 0 DTE. I think it's a pretty innovative way of approaching a 0 DTE option strategy. And you're getting uncapped growth on the dividend portion of it, right? So, and it's going to be similar actually to bank, for instance, like in the interview I did with Raj, where I highlighted that bank also has a natural growth component because the underlying stocks also hold dividend companies, and those dividend companies are all dividend aristocrats or dividend kings. So that what that means is every single year they raise their dividend distributions by a certain amount. So they're dividend growth companies. So I could see in the future S-Day and C-Day over time they will increase the distributions because they have all those dividend companies as their underlying. So the yield could go up, but it also helps stabilize the yield. So yeah, I really like the DayMax line of ETFs. I kind of wish they would expand on it. So on top of the Q-Day actually. So Q-Day is based on XLK. Maybe I'll just pull it up. So yeah, Q-Day is based on XLK and QQQM. So XLK is the index for technology, and they actually have a whole bunch of sector-specific ones like XLK, so XLP, XL whatever. So there's a whole lineup of them. I wish Hamilton, going maybe in 2026, they would actually release more of these sector-specific ones, just like Q-Day, where you could have maybe a healthcare one based on the sector, and then have the leverage portion on the index. I think there could be demand for that, and actually has more flexibility for investors to pick maybe an underperforming sector and then average into that, sort of like a recovery play. Yeah, I wish they would release maybe some more sector specific ones like Q-Day. Yeah, I'd say S-Day, you could compare it to SCHD. SDHD is a little bit different of a strategy, I'd say, but similar. Maybe I'll go into tech next, unless people have specific interest. Alright, so these are a bunch of technology ETFs. So again, the first thing I would look at is how it compared to the S&P 500. So you can see a lot of these actually outperformed the S&P 500, but there are a few that actually underperformed the S&P 500. So maybe I'll get into it, and we can look into why maybe that may be the case. But for this sector one, there's again a lot of different strategies. So all these have different strategies and different underlying holdings. So these are not technically comparable to each other, but just because they're all technology centric is why I've included them here, so you can kind of see in terms of how it looks with the other technology ETFs. And again, HHIS was launched a bit later in the year, so mid-January, so January 16th. So it's missing about 16 days of performance compared to all the other ones here. So it's not exactly representative, but just a heads up. So in terms of like performance wise on this chart, you can see QQQT is the best performing one in a general sense, and then QQQT.B. So QQQT is probably the hedged, and then the QQQT.B is the unhedged. So if I zoom out, yeah, so you can see QQQT is the Canadian dollar hedged version, and then the unhedged version is QQQT.B. So yeah, those are growth ETFs. So that's why they've outperformed. If you look at the second one, would probably be TXF. And that's interesting because TXF is a covered call ETF, but it's one of the older legacy ones that's been around for a really long time. I actually owned TXF at one point, but sold out of it just because I wanted a higher yield. But yeah, TXF done pretty well this year, and then HHIS 23.26%, and then QQQY 23.14%. So why is it that QQQT and QQQT.B has outperformed this year? If I scroll down, you can see here I have the card for it. So QQQT is the Evolved NASDAQ Technology Index Fund. So this is a quarterly distribution and has a yield of 0.29%. So QQQT seeks to replicate sort of the NASDAQ technology sector, market cap weighted. I'll actually have a video on this, I think, coming up soon, so stay tuned. But yeah, it just holds all of the technology companies within the NASDAQ. So the NASDAQ, if you've watched my interview with Raj on Evolve ETFs, he kind of goes over this one where the NASDAQ is not a full technology index, and what their spin on this is they're holding just the technology companies within the NASDAQ index. So it's excluding certain companies like Costco, Monster, Starbucks. So those type of companies are not in here, and QQQT only holds the technology ones. So as we all know, this year technology has outperformed by a lot just because of the AI, and that's probably why QQQT has outperformed this year. So yeah, no surprise that QQQT is the top performing one right now. In terms of the covered call ETFs, maybe I'll just go here and so you can see which ones are the covered call ETFs. So the covered call ETFs, we have TLF, TXF, HTA, QQQY, and ZWT, and HTAE. And then we have QMAX, TXF.B, HTA.B, and HHIS. So TLF onwards are all covered call ETFs. Let me double check if that's right. Yeah. Okay. So sort of covered call ETFs. Yeah, TXF is the best performing one. So TXF, if we scroll down, where is TXF? Let me see. Okay, TXF. So this is the CI Tech Giants covered call ETF, Canadian dollar hedged. So Canadian dollar hedged is an important aspect because Canadian dollar has done well this year. There's actually no leverage on TXF itself, but the portfolio coverage is only 25% or up to 25%. So it only yields 12.86%, and it also pays quarterly, so it's not paying out as often and has a little bit of lower yield compared to all the other ones. But yeah, it looks like it holds quite a large range of technology companies. So because of its lower coverage, probably why it's able to capture more of the upside from the technology stocks it holds going up. And that's probably why it has led to an outperformance this year. So as you can see, lower coverage gives you more upside capture, and when it comes to technology, the upside capture could be meaningful, but that's why I would say if you're interested in total returns, maybe looking at some of the highest yielding ones would be a sort of disadvantage of looking at from a total return perspective. In terms of the next best performing one, QQQY. So QQQY, I find it. So QQQY monthly distributions 13.62%. And it holds the technology stocks within the NASDAQ and it has it market cap weighted, has covered calls, no leverage, and it covers up to 50% of the portfolio. I would say this is similar to QQQT, but it has covered calls on it, basically. So monthly distribution, 13.62% yield, up to 50% of the portfolio. So there's more coverage, no leverage. So it covers more of the portfolio in order to generate a little bit higher of a yield. Yeah, it's done well so far this year. I think a large component of it is also this market cap weighted aspect. I'm working on a video right now to kind of go over this market cap and equal weight component. So hope to have it released soon, but I think it's going to be a pretty good video and kind of give you some more idea as to maybe why certain times you want to pick a market cap weighted index over ETF that is equally weighted. So Yeah, QQQL or QQCL. I still have QQCL, but I think as I pointed out, it's holding the technology, it's holding NASDAQ index, but it's not. It holds other things outside of technology. So if you want the NASDAQ exposure, I think QQCL is great. But if you want to focus on just the technology, then maybe something like HHIS or QQQY that's more focused on technology would help you get more exposure. But QQCL, I still have it. I think it's good. I would like to see, in terms of how maybe HYLD, something similar, because I was also exploring if I still want to keep QQCL, just like USCL. I was thinking of maybe getting rid of it, but there isn't another equivalent kind of similar to QQCL, or like the HYLD version. So I guess you could say HHIS or Biggie might be something like that, but I haven't found another option aside from QQCL yet that I like. So I'm holding QQCL still. So I don't know. Let's see. If I go April 8th, so since Liberation Day, see how these have performed. So since Liberation Day, in terms of the Canadian dollar hedged, it looks like the best performing one in terms of total return would be QQQT. And of course, like we already mentioned, it's just holding technology and its growth. So 72.74%. HTAE hasn't done too bad. Again, HTAE holds something different than QQT, but 54.19%. The interesting one is here between TXF and QQQY, because this middle section are cover calls but doesn't use any leverage. So these two, without the use of leverage, has actually outperformed HTAE, which is leveraged. And that just goes to show the strategy, I would say, in terms of TXF, how it doesn't cover as much because it only covers up to 25%. It's able to have it capture more of that total return upside. In terms of QQQY, I will have a video on that. I'll have a very specific video comparing HTAE and QQQY. And the reason was why, because I actually had HTAE, but I sold that one as well. So, and again, I sold it because of this performance comparison that I saw through this dashboard. And the reason why is more so not the covered call and not the leverage portion, but it's the market cap weighted and equal weighted component of the strategy. What I mean is HTAE is actually equally weighted and QQQY is market cap weighted. So if I go back to here, so HTAE is the Tech Achievers ETF. And we can see in the bottom here, it holds HTA. So if I go up here to HTA, and if maybe we'll zoom in so you can read it. But HTA is an equally weighted portfolio of 20 large cap technology companies. So the one I want to focus on, the word to focus on equally weighted. Whereas if we go to QQQY, where is it? I think it was right here. So QQQY is actually market cap weighted. So what that means is when the ETFs rebalance every quarter, when a rebalance happens, HTA is going to try and get back to an equally weighted portfolio. So it would sell some of the winners and buy into some of the losers or stocks that have underperformed in order to get back to that equally weighted portfolio. So what this does is you're capping the performance on the upside of your best performing stocks in order to rebalance the portfolio and invest it back into some of the lower performing ones. Whereas in QQQY's perspective of a market cap weighted index, it's based on the market cap of the underlying stocks. So certain stocks like Nvidia, for instance, is automatically going to have a higher allocation in QQQY because it is market cap weighted, and because Nvidia has done relatively well this year. They're not going to cap the upside when they rebalance. So HTA or HTAE together, they're capping the upside performance of the best performing stocks because they have to equally weight on a quarterly basis. And then QQQY is saying we're just going to have it market cap weighted and let our runners run, or best performing stocks run. So I would say that's why you would see the outperformance between HTAE and QQQY here. So that's one of the reasons why I got rid of HTAE, even though it's done very well. You'll see in the video that I post probably next week or something. If I had Biggie and HHIS, maybe Estee would be a good balance. Yeah, I would say they perfectly complement each other. Just because Biggie and HHIS are focused on technology and the large cap names, and then Estee is the complete opposite, just holding the dividend stocks. Hey James, thanks for tuning in. Yeah, I'm glad you found these useful. I don't know if anyone else who has it is looking at it the same way, but I think this probably would help most people who have it see a different perspective and see how to use it, just because there's so much information here, and I built it in a certain way so you can do these analysis of ETFs much quicker, and you can see which ones are performing better than others. And just like I have, seeing how HTAE has underperformed comparatively to some of the other ones gives me that kind of conviction, like, okay, there are better options out there, and then I would make that switch, right? So it's just learning about how to compare ETFs and using what's available out there. Yeah, but I think this next video I have coming up is going to be a good one, so stay tuned. Yeah, I have a video. Which one is it? It's this one right here. Introducing the Canadian cover call ETF dashboards. Watch this one. I think this one probably is the most detailed one out of all of them that I've made. I speak a little quick in it. noticed a lot of people mention that, so going forward I've tried to slow down the pacing of it, but maybe I'll speak a little bit quick on that one. But I'd watch that video if you want to learn more about how to use these dashboards. But it's pretty much how I've kind of gone through it with you guys here in terms of how you want to look at it. Like, can't emphasize like how much you can derive from just this one chart itself. Because this one chart, you can see the currency hedge difference between the indexes and how the currency has performed this year between Canadian dollar and US dollar. And then also see how, in terms of sector performance, how it's done compared to the index itself. And you can also see how it's performed compared to all similar ETFs on here. So yeah, I think it's really useful, and I can tell and do these analysis much quicker using these dashboards. But yeah, back on this chart, you can see HTA, HTAE, and HTA.B. These are the ones that have underperformed this year, and they actually have underperformed the index itself, which is another reason why I got rid of it, because there's no reason why a technology ETF should have outperformed the S&P 500 or underperformed the S&P 500 this year, with how much technology has moved this year and the AI surge. So because HTA and HTA and HTA.B has underperformed the S&P 500 is also another reason why I decided to get rid of it. It's not to say it's bad, it's just that's just the strategy, right? I think equal weighted index or ETF when it comes to a technology ETF probably isn't the best idea when you have stuff like the Mag 7 in it, which can run things like Nvidia, Google, which saw a really big run this year. If you're having it equally weighted, but you're also mixing it with other stocks that are not to the same scale and performance, you're limiting your upside potential, as we see here with HTA, HTE, and HTA.B. Because you have stocks, let me just go to it. Because you have stocks like what Adobe has done really poorly this year. Off the top of my head, I don't follow a bunch of these. So if you're equally weighting something like Adobe that has done poorly this year with something like Nvidia, which has performed relatively well, or something like Alphabet, which has done really well this year, and you're equally weighting it, you're capping your upside potential from Alphabet and you're putting it into Adobe, which has underperformed this year. So yeah, I think equally weighted portfolio, maybe when it comes to technology ETF, probably not the best idea. And I think HHIS actually came out originally equally weighted, but if I zoom in here, you can see the allocation now. They've also kind of switched away from an equally weighted portfolio. That's not to say that they don't rebalance regularly, but there's more of a difference between them, right? It's not specifically equal weight weighted, but a lot of these companies are similar in terms of market cap size. So it's not as big of an issue when you're looking at it from that standpoint. Not like HTA where you're holding companies of varying different market cap sizes. But yeah, HHIS, I don't know if they're gonna stick to maybe an equally weighted portfolio, because they've definitely kept these ones, these four that just came out, at lower percentages right now, and they're slowly building into them, which I think is the right thing to do, just because how volatile these last four are. But yeah, the next video I post is going to be on this HTA Comparison and why I sold out of it. Any other sectors that people want me to go over, or any questions you might have? If you haven't subscribed yet, trying to reach 3,000 subscribers. Right now we're at 2,817. Yeah, good question. Away from technology, so I'm going to be transferring a lot of my, actually the rest of my TFSA into Wealthsimple in the new year. So, it's kind of in the same boat where I'm trying to think of what I want to do in the new year once we have the new TFSA contribution room. I would say hold off. I wouldn't put all your money in on the first day, just because there's a lot of newer ETFs coming out. So I think Evolve has the INTI ETF coming out, so international yield. Same strategy as Biggie and Canny and Sixy, but with just international stocks. I think that would be an interesting one to add, and to add as part of diversification in your portfolio. Of course, we all heard what Harvest is coming out with, those new ETFs. Which one is it? These ones? They're premium yield ETFs, so these are interesting. So the premium yield, I think, is their way of competing with the ultra yield lineup from Evolve. So I think all of these are probably going to be 33% leverage. And what they have differently is also they're using calls and puts in the strategy here. But yeah, they're releasing a HPYB and HPYE. So the HPYB is their bank one, so this is probably competing against Sixy from Evolve. So probably 33% leverage, big 6 banks. They may add 4 more life cos or insurance companies maybe. But yeah, so HPYB. It's probably also going to be more frequent distribution, so semi-monthly with the option to go weekly. And then their HPYE, Harvest Premium Yield Enhanced ETF. So I would say this one might be closer to HHIS, but obviously with a difference of maybe 33% leverage and more frequent distributions. No details are available for this, but I think that might be the direction they're going in with this one. Yeah, HDiv. I think HDiv. I had HDiv for a little bit at the start, but I've gotten rid of it, and just concentrated into HYLD. But I think HDiv is actually, with all the new improvements they made to HYLD and HDiv, I think HDiv, I might actually add that back into my portfolio in my TFSA. But yeah, you're correct. You're absolutely right. How the bank performance and the gold performance has lifted it up this year. Both of which could potentially keep going up, right? I don't know if it will, but there's a possibility. Do I think the 33% leverage will have worse performance? You know, 33% leverage. Depends on the rest of the ETF and how this cover call strategy is structured. But I think 33% is not too much more than 25% leverage. It'll just be more volatile, and it also depends on your underlying ETF, right? So if it's on the big 6 banks, then generally they're not very volatile, so 33% leverage compared to 25% leverage isn't going to be a huge deal. But if you're saying 33% leverage on technology, so like Biggie, yeah, it's going to move a lot more just because those stocks in general are going to move. I wouldn't say it's worse performance, but you're going to see larger swings on the downside, but also higher potential to recover and then outperform in the future. Split corpse. I'm not sure if you can add those to Google Sheets, but maybe. I'm not too familiar with split corpse. So that might be the challenge in adding it to the spreadsheets, just because I'm not familiar with them and how they compare. But I could give it a thought. I think CLSA has done well this year. Yeah, CSLA 14 or 41.66%. Yeah, I think if you're looking at contribution room in the new year, you might want to hold out if you're thinking about banks for HPYB and HPYE. If HPYE is what I think it's going to be, I think it's probably going to be HHIS with more leverage and more frequent distributions. Yeah, I have Biggie, and yeah, it's moved a lot more than HHIS. Yeah, I've seen a few of them, but can't really get into them, to be honest. But maybe I'll give it another look, or if you want to share some insights on Discord. I know you can look at the premium and discounts and seeing if it's at a discount like currently or not. I don't know where you would look for it. Yeah, I know CLSA does the work, heavy lifting for you, and picks the funds for you, so there's less to manage. Yeah, I don't know. I think maybe just in terms of subs, maybe this is a bit more technical. that most people would go into. Just because it's all about numbers and spreadsheets, and general people just want to be told which ones to buy, right? So yeah, HPYEs from Harvest. Let me know if there's another spreadsheet you want me to go over, or like a dashboard. One might be the YieldMax ones. These YieldMax ones just... I can't recommend them. Yeah, if I just look at Tesla this year, since January 1st, 2025, it's up 25.29% in terms of total return. TSLY from YieldMax is down 41.49% in total return. Actually, this is not right. I think something's wrong with this one. This should not show 0. Maybe it's a different date. Yeah, this is incorrect. I have to double check on why this is the case. Maybe it's not pulling it correctly. But if we look at another one, what's another one? Coinbase is popular. Yeah, Coinbase. Yeah, Coinbase. So Coin since January 1st, 2025, down negative 7.9%. Coney, on the other hand, negative 13.62%. So it's not a huge underperformance, but it is underperforming. Let's see MSTR. Oh, they actually, well, according to this anyways, MSTR is down 47%, MSTY is only down 13%. So since January 1st, it looks like it is outperforming it. It's probably because of how MSTR has gone down in price in the last 6 months. So because it writes on the entire portfolio, it generated a ton of premium, and it has kind of helped it not underperform as much. So yeah, this would have been, I mean, you're still underperforming overall by negative 13%, but you're just not underperforming by more in terms of like negative 47%. So you can see how it kind of helps in terms of the strategy. In terms of Ulti, I had Ulti for a little bit. I don't have it anymore. Let's just keep it at that. Ulti this year looks like 1.37%. Not great when you consider, I mean, it changes the holding so often, so you can't really compare it to anything. But 1.37% in a year where the indexes have done 18 to 20%, 22%, you're underperforming by a lot. Yeah, maybe we'll check in this. look into the split corps a little bit more. Yeah, I think BMax is a very interesting one. I think BMax, I have it listed underneath this multi-sector one, and you can see it's actually the best performing one out of all the ones that are here. But again, all of these ones hold different holdings, so they're not directly comparable. But in terms of like how it's composed of like a mix of multi-sector or diversified baskets, BMax actually done very well. And it's actually beating the S&P 500 this year, so it doesn't yield the most, right? BMax 9.74%, has 33% leverage, and it just holds a bunch of their own ETFs. So you got some split corps, healthcare, European, global, infrastructure, tech, yeah, a bunch of different things. So this is why I have it in the multi-sector spreadsheet. Yeah, BMax is done well. ENCL and oily. ENCL and oily, I have it under oil and gas. I'll just answer this question before I get into it, but all this hard work in building these spreadsheets, it's mostly for my own entertainment and analysis. I'm pretty far away from retiring, so it's fun for me, and I think I want to share it with others who are also interested in this. So yeah, it's more of a fun thing, and trying to see how I can get a little bit of an edge now, and hopefully this little bit of an edge in picking the right ETFs and stocks will eventually lead to a better retirement in the future. So that's why I build all these. So oil and gas, Canadian oil and gas. So you can see first thing via V and VSP, so comparing it to S&P 500, the oil and gas sector has underperformed this year, so hasn't done as well as the index. In terms of cover call ETFs, I think it's ENCC, ENCL, and oily together. You have to note here that this chart is incorrect because oily was launched in March. So this chart doesn't correctly reflect the performance. So in this case, I would actually go to the next tab over. And then I would see here, oily came out on March 26th. So I would update this one to March 26th in order to see the correct performance. So you see everything updated to March 26th now. So in terms of performance, looks like 26 is when it came out, but the 28th is when the data starts. So I should actually go back to March 28th. And that's just from Google, right? So Google doesn't track, maybe missed the first 2 days or something. So now we're comparing from March 28th to today. So March 28th to today, it looks like oily has done 3.63%, ENCL 6.54%, ENCC 6.1%. And then in terms of the growth, it looks like the ones that have outperformed is XEG. So yeah, there's a little bit of underperformance, but again, you have to look at the underlying stocks. So XEG holds, what is this? More than 26 different companies inside it. it doesn't have leverage. And just looking at it, I think, so target exposure to Canadian energy sector. I think it holds both US and Canadian stocks, so that's why it's a little bit different. When you're trying to compare it to something like ENCL, which holds ENCC, and ENCC holds these 9 companies, it's not really a fair direct comparison, I'd say. Even ENCL and Oily, it's not... They're close, but I wouldn't say it's direct. So Oily has 10 holdings. ENCC has 9 holdings plus NRGY. NRGY holds these 9 or 10 stocks. I don't know if they're exactly the same. Let me see. I don't know if I can do this. No, I can't do that. Let me see. So Synovus. Yeah, so the difference is Synovus, it looks like. And Pembina. So Synovus and Pembina are in Oily, and then this one holds Southbow and something else, and Meg Energy Corp. So a difference of 2 companies between Oily and ENCC. So that's why maybe those 2 companies in ENCL outperformed Oily, or the 2 in Oily. Because otherwise the Oily 25% leverage, ENCL 25% leverage, ENCL is up to 50%, Oily's 33%, so Oily covers less, which is why it has like a little bit of a lower yield. So 16.9 versus 17.14. But it captures more upside, potentially, with the lower coverage ratio. So yeah, they're very close comparisons, ENCL and Oily, but it looks like ENCL has outperformed by about 3% this year. From the inception of Oily. Yeah, Utes is not in this one, but Utes is in a different one under Canadian Utilities. I don't own Utes just because I don't like the telecommunication sector, and Utes has both of them. So Utes has both, actually more than both of them, has TELUS, Rogers, Bell, all 3 of them. So I've owned TELUS and Bell in the past, sold them both at a loss. I'm not interested in getting back into them, so that's why I don't own Utes. But yeah, I mean, telecommunications and utilities are relatively stable. And it looks like Utes has done fairly well this year. I mean, not quite as well as the index, but done relatively well. Yeah, and like you said, the price barely moves. If the price barely moves, then your return is going to be the yield, right? So the yield of Utes is 18%. So you can see on the spark line here, yeah, like you said, the price barely moved this year, but because the price barely moved, your return is going to be your distribution or yield. So 18.3%. And then if we scroll to the top, you can see that, yeah, this is kind of the case where your return is 15.5%. So yeah, your return basically is the yield from Utes this year. In terms of why maybe some of these ones have outperformed, so HUTS is the best performing one for Canadian utilities, and HUTS is actually a leveraged growth ETF. So leveraged growth means it has 25% leverage. This one pays out a monthly distribution and has a 6.42% yield. And then in terms of holdings, it has 12 holdings. Again, it has telecommunications in it, which I'm not a fan of. So yeah, 25% leverage gives you this outperformance. So if you were to compare it to something that isn't leveraged, see if there is one. You could say YieldMax, but they're not directly comparable. It's missing one stock, or they're a bit different. There's a few that are different actually, but YieldMax is not leveraged, and without the leverage, it hasn't done very well. 8.27%. It's also because it's covering 50%, right? So when you cover more of the portfolio, you're giving up more of the upside. And you can tell from the spark line here for the 1 year, it's trended downwards throughout the year. So stock price going down and also covering more of the portfolio might be the reason why. Yeah, so I'd say utilities, pretty stable sector overall. Performance is relatively the same among all of them. Yeah, margin. It's because Wealthsimple is pushing margin a lot lately. And I already put on my Blossom saying how they're also going to allow you to link your non-registered accounts to give you more leverage or more margin. I think if you use it wisely, it could be beneficial. I'm still using some margin right now. I'm probably in the new year might increase it a little bit, but I'm not using an overly large amount of leverage. Let me know if there's another dashboard you want me to go over. Yeah, I think with the margin, you just have to set a limit of how much you can use relative to how much you have available, and not put yourself in the risk of getting a margin call, right? No, I would say the leveraged ETFs are not margin because you're not personally liable for that leveraged amount. It's the ETF providers. Using margin on your own is quite different, where you have to manage it yourself and keep track of how much margin you're using and how close you are to a margin call. Because there's margin requirements within an ETF. I don't know, wealthsimple margin. Yeah, so this is what it looks like on wealthsimple. So this person used $800 in margin, so it's negative $800. Portfolio value is 1,864. His margin requirement is $559, and he has $505 available. So he has to. So he's using only $800 out of the total 16. So he just has to make sure this amount doesn't go to zero, because once this margin available goes to zero, then you're going to be in a margin call, right? And then there's also the interest rates that you had to put in every month for the amount that you've borrowed on margin. So you also have to factor that into your total returns. If you are using cover call ETFs to pay down this margin, then you also have to account for that in your performance, because that's a performance drag, because every month you lose some of that distribution to interest. But just in general, margin requirements, you want to look at your margin requirements and see what the margin requirement is, because those margin requirements can increase at any time if wealthsimple or the lender thinks it's too risky, and if you're not able to have enough of a buffer before you hit the margin available going to zero, then you're going to be in margin call. The margin call is not the worst thing in the world. You just have to put in more money, but if you don't have more money, then that's where the problem is. So you want to stay as far away as possible from putting yourself into a margin call. Yeah, like this picture here. I don't know what this person did, but this is what it looks like when you're in a margin call. This guy probably over leveraged on something. And negative 216,000. Yeah, I would say beware of HHIS and Biggie in terms of in a margin account, just because it can drop and they can increase that margin requirement. So just because HHIS is at a 30% margin requirement right now, they could easily change that to a 50% or 60%, right? So if we see something next year where we have something like a tariffs or something related, and HHIS drops 20%, it could raise the margin requirement. So if you leave enough of a buffer, then you might be fine. But yeah, they can hike that margin requirement whenever they want. yeah, if you don't need it, don't bother with it, but I would read up on it, and maybe if you do want to try, maybe just put in like $100 and then you can test and get familiar with how it works. And then get more comfortable. You can put more money into it or use more margin. But yeah, some people get addicted because they see they have lots of margin available to use, and then they want to use all the margin because they want to maximize their returns. And that's not how you should be approaching margin. You need to leave enough room so you're not putting yourself in a margin call. Yeah, you can link your TFSA to a margin account. Only thing is, if you can't pay off that margin call, then they will liquidate your TFSA assets. Which sucks. Obviously, you don't want to be in that position, but worst case scenario, if you do get liquidated, a portion of it, you can recontribute, I think, next year afterwards. So, but thing is, it depends what they liquidate, right? So if they liquidate a position that's in the red, then you lose that contribution room because you've realized the loss. I'm not too sure how that works because I haven't been in a margin call yet, but tricky. You never want to be in a margin call. Yeah, maybe I'll just go over this. Nope. I have that online. Oh well. Yeah, I think any questions, last minute questions you want me to kind of go over or answer? Yeah, I'm looking forward to New Year coming up, getting that TFSA room. Yeah, hopefully you guys learned a little bit in terms of like how to look at comparing stocks and ETFs. Yeah, if you're interested, you can head over to Patreon and become a member. I think it's right now it's $3 a month for access to spreadsheets and dashboards, and you get access to everything I have here. So you get access to the 21 dashboards, and then you also get the community spreadsheets. So currently there's 3. I'm currently working on another one right now on sector rotation and how to visualize that, and a fear and greed index as well. So should have that ready maybe sometime next month, but everything's in place. I just gotta make it look nice. As you probably see, try to put a lot of effort into the overall design and usability of these. So yeah, $3 a month, I think it's worth it, especially when you're putting in thousands of dollars into these ETFs, you want to know you're putting your money into the best performing ones, right? So these can help you analyze and take a look at which ones are the best performing ones, and then you can make decisions where you want to put your money. And for $3 a month, I think you're gonna easily make that back, right? So yeah, head over to Patreon if you're interested. All right, so I'm probably gonna wrap up here. If you haven't subscribed yet, feel free to subscribe. Like I said, I have some videos coming out in the next week or two on some of the ones I've sold. So HTAE and USCL. So it should be good videos. It's going to be kind of similar to what I've talked about already in the stream, but more slowed down and more thought out in terms of the reasoning, right? So yeah, stay tuned, subscribe if you can, and hope everyone has enjoyable rest of their weekend and have a happy new year. All right, thanks everyone.